time has come for the Cobra to rise up and reveal himself.
The effects of inflation. And look at this chart. Bad inflation in an economy is like a bull in a china shop. It just wrecks an economy because it just wrecks all facets of the economy. First, let's start with households. First is a funny little name called shoe leather cost. This represents the opportunity cost of people having to run around and do comparison shopping as they search for the best prices in a time of purchasing power decreasing and that price level increasing. And shoe leather literally refers to the shoe leather that is being worn as people run around looking for different prices. But the worst effect of inflation, so like simple little, sometimes it's a one-off multiple choice question, what is shoe leather cost? The time spent kind of looking for alternatives due to the high prices. But worst for the household is the erosion formula. And this refers directly to the purchasing power of the dollar that inflation erodes. So the real rate means the true purchasing power, what your dollar can actually purchase. The nominal rate is just the headline rate. Like, let's say you make $50,000 a year, but that doesn't mean you could actually purchase $50,000. The real rate is the nominal rate adjusted for inflation. So the nominal rate minus the inflation rate. And this is the wrecker to households, because what does this do? This erodes fixed savings. This erodes fixed income. So this is the worst for retirees. Retirees on a pension, retirees on Social Security. Social Security is a fixed income. So that means it erodes fixed bond values and the investment vehicle of bonds, which have a fixed, and fixed means it does not change over the lifetime of the vehicle, of the investment vehicle. So bonds will increase at a certain percentage each year, or give you a coupon rate at a coupon income, a fixed income called the coupon rate, also at a fixed value each year. It erodes wage increases, and it erodes financial investment increases as well. So let's take a look at it. Like, let's say for fixed incomes, and this is why it's such a killer for retirees, inflation, and which is why with retirement, you want to start investing in your retirement as soon as possible. As soon as you get that first full-time job, you need to open up a retirement account and start building your financial investments in the stock market and the bond market, because we just saw from part 1, an acceptable amount of inflation is 2% per year. That means your savings accounts, let's say a savings account, a good savings account at a bank is 1%. Let's say the yearly inflation rate is 2%. So even though your money is sitting in a savings account and it looks like it's growing, your money's true purchasing power, when you're going to need it, is actually shrinking at a negative 1% rate. So your money just sitting in a bank is actually losing its purchasing power. So when you're 22, when you're 23, when you get that first full-time job, you need to remember that this number is always going to be working against you. You do not want your money to be growing in a bank, but not really growing. In fact, it is shrinking. You need to start investing in more aggressive financial retirement accounts. So as soon as you're 22, Start researching how to invest in retirement accounts. Some jobs come with it, like 401ks. City, state, and federal jobs have like TDAs, and with the city, state, and federal government invest your money for you. But you can open up individual IRAs and Roth IRAs, but you have to remember that this number is always working against you. You need to strike first and strike hard and always work against this number. And especially because when you're a retiree, you can not just rely on Social Security. Social Security is a fixed income. Social Security increases at a rate of 0%. That means every year you are retired, your fixed income actually, if inflation is 2%, remember this is an acceptable number, 2%. That means every year, as a retiree, your ability to purchase goods and services decreases at a negative 2% rate. That's why in Cobranomics, invest hard, invest often. You need to strike first against the inflation rate. Businesses. Businesses have also a kind of funny little term called menu cost, and it's called menu cost because this refers to the opportunity cost of businesses having to redirect resources to then adjust for the change in prices, and it's called menu cost after restaurants. Let's say prices go up. Restaurants, what do they have to do? They have to readjust their menus. What does that mean? They have to now pay employees to go type up new menus, print them, laminate them, and that is all time that is wasted adjusting to the increase in inflation. That's why maybe sometimes you have been to a restaurant where they've like crossed the price out or very classily whited over or white taped over the old price. That's so they don't waste too much time with menu costs, and this is why many delis have chalkboards instead of laminated menus on the top of the wall, so they don't have to waste time and have that wasted opportunity cost, those wasted resources of adjusting to increasing prices. And the other aspect, the second effect, is what's called unit of account costs. That for a business, it is difficult if prices are increasing, it is difficult for the business to gauge I'm talking about like accounts, are they making money? So unit of account is the difficulty in the business to gauge, are they making more money, or are they just making, are they not spending, are they making more money, or because they're selling more, or are they making more money because prices have increased in society and they had to raise their prices. So unit of accounts makes it difficult for businesses to assess their own income, and from an investment perspective, for people who want to invest in a business, like, is this business making money, or is their revenue really increasing, or are prices just increasing and it's showing they're making more money when it's really not? So that illusion between nominal versus real makes it difficult, the idea of unit of account, and makes it difficult to gauge the success of a business due to the rising prices. Are they selling more, or are they just making more with less, and they're actually not really selling more? They could actually be potentially losing money in the long term. For the government, the effect is what is called inflation temptation. And what that means is the government actually doesn't mind when prices go up. Because if prices are going up, let's say government has, like in New York, we have a sales tax with 8.76%, so let's just say 8%. So let's say it's $10, 8% of $10 is 80 cents. And however, now let's say prices go up to $12. The government, let's say if you buy something for $10, you get taxed at an 8% rate. But let's just make it like 10%. So let's say the government has like a 10% sales tax. And so for $10, you buy something for $10, the government gets $1, 10%. Now, let's say prices go up to where that one item you bought is now $12. And let's say the sales tax now could stay 10%, but now the government gets 10% of $12. So when you make that purchase for $12, the government revenue actually went from $1 to $1.20 without raising their taxes. So this is called the government inflation temptation, is that governments don't actually mind inflation because it allows them to increase their revenue without increasing taxes. And so it is politically very unpopular to be a sitting politician with inflation. However, there is that temptation, because that secret temptation, because it does raise government revenue without having to raise taxes. And now the banking system. But also arguably, the two most important aspects of this is the erosion formula, and now we're going to see how this erosion formula plays out in the banking system with what is called the inflation tax. That wealth is technically transferred from lenders to borrowers, that banks are hurt by inflation because banks lose a real rate of return on fixed interest rates. Remember, banks lend money and for cars, for student loans, for home equity loans, and you have to, and because the bank lent you that money, you have to pay that money back plus interest. However, we saw here with the erosion formula that the real interest, the real rate of return decreases with the inflation rate. So banks are negatively impacted by that because let's say you took out a 4% loan, you still have to pay the bank back that 4%. But then you get to go, here's your 4%. Haha, it's not really 4% because let's say there's an inflation rate. So even though you are paying the bank back that 4%, the bank is really only getting a purchasing power of 2%. So while the bank does get its 4%, it's really only getting a purchasing power of 2%. So that's the inflation tax, where lenders at fixed rates are hurt by inflation because even though they're getting that fixed rate back, they are getting it back at a lower real, that the money they are getting back is worth less than the money they lent and the money they're expecting to get back in the nominal rate. So lenders are hurt with a fixed rate and borrowers benefit. The borrower still has to pay this money back, so even though we get to say, haha, this money's not worth as much, the bank still says, haha, you're still paying us back this money. But the money the bank gets back is worth less than it was expecting. Now banks aren't stupid, and banks are the oldest business in economics. So Irving Fisher, economist, came up with this idea of how banks can protect themselves from the inflation tax. Again, it's not an actual tax, it's the idea of this transfer of wealth from lender to borrower. So what Irving Fisher said is that before banks give out a loan, the nominal rate should equal the current real rate of return the banks want plus expected inflation rate, so that when inflation does set in, the nominal rate already has that expected 2% built into it to protect it from the oncoming inflation. Right? Banks are not a nice business. Right? Banks are out for profit, and banks will protect their profit. And so in order to protect their profit, when we take out a loan from a bank, that loan has inflation, has expected inflation, has that yearly 2% inflation already built into it. So let's say banks want to maintain that 2% real rate. Let's say banks want to profit at 2%. So what will they do? You're not going to take out a loan at 2%. Banks aren't going to give you a 2% loan, because if they give you a 2% loan, so if banks don't add expected inflation to it, then that 2% loan when inflation does hit, it will be 2% minus the nominal rate of 2% minus 2% equals, banks actually get 0%. So let's say banks want to maintain that 2% interest rate. So what banks will do is they will add 2% expected inflation to their loan. This means the loan you take out, or we all take out, will be 4%. So when that erosion formula hits, when we pay the bank back, even though that money is inflated, the bank still maintains its real interest rate. Let's take a look. So let's do our interest rate formula. So let's say we have our nominal interest rate. Inflation hits 2%. The bank's real rate of return remains 2%. So whatever the bank's goal is, whatever the bank's real purchasing power goal is, it will add expected inflation onto that goal to maintain that goal. So when inflation does hit, because it added expected inflation into the rate, that fixed rate that we sign, and this is always too why you always sign a fixed rate loan, because if it's a variable loan, if it's a loan where the interest rate can change, inflation, as we saw from the very first slide, inflation, the US government accepts that inflation, that a 2% inflation rate is okay. So a variable loan is just an invitation for the bank to raise your interest rate. You never do a variable loan, because that means you're betting against inflation, which is a very bad bet. So you always want to do a fixed rate loan, because even though the bank has already built in with the Fisher's hypotheses, expected inflation, at least there is that potential of the inflation tax. Whereas the variable loan, you do not bet against inflation not happening. That's a bad bet. And so here we see why inflation is so devastating to an economy, because it literally does affect from households to businesses, government, and banks. It affects all aspects of an economy. So inflation is complex, but remember, again, it is that decrease in purchasing power, and that decrease in purchasing power is measured as that percentage, that inflation rate percentage of the difference in those consumer price indexes. And as the inflation rate increases, it has all of these potential negative effects on the economy. So inflation really could be one of the most devastating things to happen to an economy, and we've seen plenty of, unfortunately, historical cases where inflation completely derails a nation. And I hope you have a better understanding of why that's so devastating. And people, and we just have all these historical examples of just inflation totally wrecking nations and just derailing them politically. kind of a sour note to end on, but thank you for watching. There's a lot going on in this lesson, so definitely pause and re-watch the different aspects of it. Remember, especially because of inflation, invest hard, invest often, no feelings. Money never sleeps. We'll see you next time.